In case of secondary markets, stock prices are a result of continuous buying and selling by all the various types of participants in the market. This includes the retail investors, the institutional investors, short-term and long-term traders, and market makers. Since this group of participants covers people from all walks of lives, including those individuals who are trading in the stock of a company they are employed in, it would be fair to assume that some individuals who trade in the market might have access to insider information as well. This implies that every information available to anyone, that is both retail and institutional investors, is reflected in the market prices of the stock. Hence, it is said that the prices reflect the collective wisdom of all market participants, and the price of any security in the stock market is set by this collective wisdom of participants. Initial public offering or follow-on public offering. Initial public offering or IPO is the first public offer made by the company. Post IPO, the shares of the company become widely available for investment by the public. Through the IPO, there is a change in the shareholding pattern of the company. After the IPO, instead of just the promoters, now all kind of investors also become the shareholders. IPO involves either fresh issue of shares by the company or offer for sale by existing promoters or institutional investors. In case of fresh issue of shares, the company issues new shares so that they can be sold to the public. On selling the new shares, the capital of the company increases and the percentage shareholding of existing shareholders comes down. In case of an offer for sale, the existing shareholders of a company offer a part of their holding to other investors. The share capital of the company does not change as the company doesn't issue new shares. This is because the proceeds of these sales go to the existing shareholders who are offering their stake for sale. Hence, the proceeds do not go to the company and there is no change in the capital of the company. As a result of sale of shares, the percentage shareholding of existing shareholders who have offered some of their shares for sale comes down. Now let's look at FPO or the follow-on public offer. The FPO route is taken by an issuer who has already made an IPO in the past, that is by companies who are already listed on the stock market. When such companies want to make a further issue of securities to the public, they can do so by offering a follow-on public offer. The company may take an FPO route if it requires additional capital for growth or in order to restructure its capital by retiring debt. Some FPOs may also happen through offer for sale, where existing shareholders offer some of their shares for sale. This may happen if the promoters would like to dilute their holdings in the company after the lock-in period imposed at the time of their IPO is over. Starting with the fixed price issue. In a fixed price issue, the company issuing the security decides the issue price by consulting a lead manager. A lead manager may be an investment banking firm. This lead manager justifies the price based on the expected performance of the company and also on the basis of price of shares of comparable companies in the market. The issuing company then may inform the public about the issue price along with all the relevant information related to the company's past financial performance. The investors can then take a decision on whether they would like to invest at the issue price or not. The other way the pricing of an IPO is decided is through the book-built issue or the Dutch auction. In case of the Dutch auction, the price of the issue is decided by an auction. The company, in consultation with the lead manager, specifies a floor price, which is the minimum bid price they are willing to accept for their security. Alternatively, the issuer may specify a price band, that is a minimum and maximum price within which the investors can bid. When the issue opens, the investors place a bid price and a corresponding bid quantity. This bid price is required to be above the floor price or within the price band. Once all the bids have been received, the issuer of the security, in consultation with his lead manager, decides on the cut-off price for the security. All bidders who have bid above this cut-off price get an allotment of shares at the cut-off price. Let's understand this with an example. Let's say a company A wants to issue 1000 shares through a book-built offer. Let's say the company has decided on a price band of 120 to 144. Let's assume that the company has received all these bids. The company would start by sorting the bids from highest to lowest. It would start by allocating shares to the highest bidder first, and then progressively moves down until all the shares that need to be sold are allocated. So in this example, first the company allots 200 shares to the bidder with the bid price of 144. Since the company intends to sell 1000 shares, it still has 800 shares left. Hence, it will look at the next bid at 140 and allot 300 shares. After both these allocations, 500 shares are still left. So the company will look at the next bid. Here it will allot another 500 shares. So now the company has allotted all of its 1000 shares. Since 135 is the lowest bid price at which shares were allotted, this becomes the cutoff price. All investors who bid at this price or higher than this price are eligible for allotment. For the benefit of the investors, the company may also choose to decide the cutoff price at a lower price than the price at which the issue is subscribed. Sometimes companies also have a clause for retail investors to be allotted shares at a discounted price.